I used to be a big believer in trading the gold to silver ratio, and while I managed to trade the majority of silver I had accumulated during the late 90s and 2000s in the spring of 2011 at a gold to silver ratio well under 40, the results were disappointing in hindsight. Had I not nailed the timing, the results would have been even more disappointing. I've learned a lot since my early days as a precious metals investor. It used to seem to me that trading the gold to silver ratio was a no-brainer, a surefire way to compound ounces. What could be simpler? Look at this chart. The gold to silver ratio bounces back and forth between extremes, providing the savvy metals investor an opportunity at a risk-free profit. All one needs to do is buy silver when the GSR is greater than 70, and then trade it all for gold when the GSR drops below 20. Or is that 40? Wait, maybe it's 50. Aha! Now you can immediately see one of the pitfalls of the no-brainer strategy. Figuring out the bottom is actually pretty tough, but even if it was possible to get the extremes in the GSR right, my years of being a precious metals investor has taught me that such a strategy is actually a waste of time. When I say that, I'm not saying that the GSR won't be profitable. It certainly can be. What I mean by waste of time is that the amount of time it takes to realize profits from such an approach leads it to be suboptimal. You really can't do it consistently. Thus, the time can be put to better use. Let me show you why I believe that's the case, especially today. Let's see how long it might take an investor to capitalize on swings of varying degree in the gold to silver ratio. Let's start by looking at how long it took to hit certain extreme levels starting from the peak in 1941. Moving from the 1941 extreme of close to 100 down to a level of 40 took about 10 years. Now, 40 wasn't the optimal place to exit the trade back in the early 50s, because if the investor had waited another 16 years, he or she could have exited at a GSR of less than 20. But the investor could not have been assured that the GSR would have dropped beneath 20. Look at what happened to the investors who bought at the peak in 1991 at a GSR near 100. If they had gotten out at 50 or even 40, they would have made a nice profit. On the other hand, waiting for the GSR to drop below 20 resulted in disappointment, as the ratio rose from a low of 32 back up to a level even higher than the 1991 peak. The best place the investor who bought in 1991 could have gotten out was about 7 years later, in 1998. This would have maximized the rate of return. Let's just use the timescales as a reference for how long it might take to go from peak to trough. Traveling from a peak to down to a trough near 50 might take 7 years. Traveling down to a trough near 40 might take 10 years. Riding the GSR all the way down below 20 might take 26 years. This, of course, isn't a prediction. It's just an illustration of how long riding the GSR from peak to trough might take. And that is, of course, that the investor knows the best time to exit the trade ahead of time, which is really impossible to know. So now that we have an idea of the timescales, let's see what this could mean, practically speaking, in terms of rates of return. In what follows, I'm going to be very generous and assume that a person can nail a trough in the GSR precisely. Let's do some real-life calculations using current market prices for physical metal. We'll use as a starting point the purchase of 1,000 ounces of physical silver in the form of generic 100-ounce bars. I'm choosing 100-ounce bars in bulk because at $2,956 each, they represent one of the least expensive ways to buy physical silver today at a premium of 11.5% above spot. Historically, this premium is high, but as you'll see in a minute, so is the buyback premium, so the spread is indicative of what was available in the past. Purchasing 10 of these will result in a cost of $29,560, which will be the cost basis. This $29,560 could have been used instead to buy gold. I'm going to pick Gold Eagles for this example, but it doesn't really matter what gold is picked because we're only going to consider the one-way trip of trading silver for gold and not the round trip. So while the premium paid for silver matters a great deal, the premium for gold in this example is largely irrelevant. The $29,560 could have been used to purchase 14 1-ounce gold eagles plus a quarter-ounce gold eagle. This is our opportunity cost, and we're hoping that we can trade in the silver at some future time to obtain more than 14.25 ounces of gold. Currently, 100-ounce silver bars are fetching a 2% premium on the buyback from the dealer. This is historically high. In the past, I recall a good buyback price was about a 3% discount to spot. We'll just go with the most favorable assumption that the 2% premium will persist. If premiums go down, it will just make these numbers worse. Let's also assume that the gold price stays where it is and the silver price increases to result in the desired contraction in the gold to silver ratio. Again, this is a generous assumption because it will minimize the tax drag. Oh, and I'm not going to pay taxes, I'm sure some are thinking. I'll have to treat as a separate video why not paying taxes on metals transactions is likely a bad idea in today's environment. So, let's take the case of being able to nail a sale on the nose at a GSR of 50. We'll take our time frame of 7 years from the historic GSR chart. Because of the rise in silver price, we're able to sell the 1,000 ounce of silver bars for a dollar value of $39,624. If our marginal federal plus state tax is a modest 15%, we'd have to hold back some of the gain in order to pay the taxes at the end of the year. This would leave us with $38,114 to buy gold with. Now, I'm being very generous with the 15% tax rate, but I wanted to assume that some taxes would be paid. I'm also being very generous by assuming that the gold price stays put. If it goes up along with silver, then the gain on the silver sale will generate more taxes. The $38,114 can be used to buy 18.4 ounces of gold using the current gold eagle price. This would be 18 1-ounce coins and maybe 4 10th-ouncers. This is certainly a profit. Instead of the 14.25 ounces of gold that we would have had we just bought gold at the beginning, we now have 18.4 ounces. Excuse me. This is 29% more gold. It's certainly something to be happy about. Unfortunately, we had to wait 7 years to make it happen. And this is where the main problem lies. The rate of return on this trade is only 3.7% per year. And that's if we get lucky and can sell at the precise trough and the buyback premiums don't change. We can do these calculations for scenarios involving GSRs going down to 40 and down to 20. I'm not going to go through all the numbers in detail, but I'd like to highlight that for the GSR of 40, the rate of return turns out to be 4.7% per year, and for the GSR of 20, the rate of return turns out to be 4.3% per year. How on earth is this possible? If the GSR drops to 40, we'll have 58% more gold, and if the GSR drops to 20, we'll have 3 times more gold than we could have had just buying gold at the beginning. The reason for the low rates of return is the amount of time that it takes to get there. According to the historic GSR chart, it could take 26 years to go from a peak near 100 to get to a GSR of 20, and that assumes that it gets there at all. Remember, in the previous chart, I showed that it took more than 30 years from the peak in 1991, and we haven't seen a GSR of 20 yet. And this brings me to the last column on the table. If instead of nailing the trough in the GSR perfectly, the investor has to bail on the position with an unchanged GSR, then the total loss in purchasing power will be 7%. I won't calculate the rate of return because it's impossible to tell how long it will be before either needing the funds or just growing impatient with silver. But that's beside the point. Let's focus on rates of return for the investor who is able to pull off this trade and nail the trough in the GSR. 50 is a GSR that I think is possible. Such a trade can generate a 3.7% per year rate of return. Getting to 40, I think, is a modest probability. If you can pull it off, you'd get a 4.7% per year real rate of return. Getting to 20, I think, is a very remote possibility. But even if it can be pulled off, the amount of time to get there is long enough that the real rate of return is only 4.3% per year. Now, these are certainly attractive rates of return, but one has to be very lucky in order to be able to get them. Miss the trough, and the rate of return will be considerably lower, if positive at all. I would much prefer to be able to generate a rate of return that I can count on, and there are certainly investments that I can name that generate a real after-tax rate of return better than 4% per year with some degree of confidence. Which brings me back to the 35% gold, 65% stock portfolio. You can see that depending upon which rebalancing strategy is picked, this portfolio has generated a very reliable and respectable 6 to 7% per year real rate of return over the past 50 years. Taxes were ignored in this chart, but if we assume the same 15% tax drag, it would shave about 1% of the rate of return off, leaving a real after-tax rate of return of about 5 to 6% per year. In reality, we wouldn't be paying taxes on all of the portfolio gains each year because the turnover rate wouldn't be high, but 5 to 6% per year can be reasonably counted on. Now, I'd give this type of operation a higher degree of certainty of being profitable and making good returns than making swaps of silver for gold. So there you have it. That's my current stance on trading the gold to silver ratio. It can be done profitably, but there are better ways to generate a return. I used to be a big believer in trading the gold.